everybody. Thanks for joining us today for our Andersen Tax 101 webinar series. Today, myself, Krista Rabidoux, and Emily Yu from our Vancouver office, who's a director, will be talking to you about delinquent U.S. tax filing strategies. And that's related just to individuals who do have a U.S. tax filing obligation and whether or not they've been up to date with all of the income tax or reporting forms. So good morning, Emily.
Good morning, Krista.
So first off, just to start some housekeeping items here, you will see throughout the webinar that there are some polling questions. This is due to NASBA and us to be able to provide you with CPA credits. And so in order to receive those credits, you need to participate for 50 minutes and answer the polling questions throughout the webinar, and then we would send you a certification for your credit. If you have any questions throughout the webinar, you will see on the screen there is a Q&A. If you can just type your questions in there, and we will get to those questions at the end of the webinar. If there's some more simplistic or housekeeping items, both Kenneth and Janice are on the other side behind the scenes that are monitoring those questions. And so they will be able to answer you. Otherwise, we'll wait for the end of the webinar to answer all questions. If we don't happen to get to them all, we will make sure to get back to you afterwards. Also, once the webinar is over, you'll receive a link to the survey. We appreciate it if you take time to answer that survey and let us know how we did today, as well as if there's any other future subject matters you want us to deal with on Tax 101 series. And then finally, if you need closed captioning, there is a button there for live transcript, and that will allow you to see the closed captioning appear on your screen throughout the webinar. So today we're going to take some time to talk about different items that relate to delinquent filings. We're going to first start just with going back and revisiting who is a U.S. person and who has an obligation to file U.S. tax returns. Also, we're going to talk just briefly about all of the different types of reporting forms that exist in the United States, aside from an income tax return. So quite often we'll see U.S. tax returns filed with the income reported, but a lot of the foreign reporting forms missing, which in the United States is quite extensive for U.S. persons who have to file on a worldwide basis. And then we're going to talk about a few of the different methodologies that exist for an individual to get caught up on their filings if they are delinquent, whether it's delinquent with a filing at all, or if there's an amendment that needs to be done because some of the forms that were missing that Emily's going to go through in a bit, some of those forms were missing. And so they're just different procedures. And there's one that's a Streamlined, which can be a domestic filer or a foreign filer. Domestic being someone who's physically in the United States and living. Foreign filer is someone who's outside of the United States. Then there's, if you're missing certain information returns, there's a program you can use for that. The foreign bank account, financial account reporting, there's a different reporting system that exists for that. And also just a fairly new one that came out in recent years here on if you have renounced your U.S. citizenship or your or abandoned your green card, or sorry, just citizenship. There's a certain program that they came out with to allow people to get caught up in those situations. And then there's a few other ones that aren't used quite as often, but we want to make sure to talk about them in our webinar. So we'll kick off first here, just talking briefly about who has a U.S. tax filing obligation. Now, this can vary depending on what your status is with the United States. The first one is a U.S. tax citizen, or a U.S. citizen, sorry. So a U.S. citizen, some people think is just an individual who was born in the United States, but that in of itself isn't always just a requirement. You can also be considered a U.S. citizen for filing purposes if your parents were U.S. citizens and had spent time in the United States as a U.S. citizen. So this actually catches a lot more people than some might think. Myself, for example, my grandparents were citizens. That doesn't make me a citizen because my mother was not born in the United States and never lived in the United States. So she, even though maybe could have been a U.S. citizen. It did not pass to me as a third generation, but said my mom lived in the United States and was born in the United States. There's a possibility that I could have been a U.S. citizen and had a filing requirement, even though I myself was never born there or lived there. So U.S. citizen is required to file on a worldwide basis and report all of their income to the United States, and all of their foreign reporting obligation forms is required as well. And again, Emily's going to go through a lot of those in the future slides here. Next is a U.S. green card holder. So this one is any individual who physically still holds their green card, whether or not it's valid for immigration purposes. Maybe it expired years ago. So it's actually useless for immigration purposes. You don't have the rights of it, but from a tax filing obligation, you must still file on a worldwide basis. Unfortunately, this is not something that this is an area where immigration and tax don't actually talk to each other. And so U.S. green card holders, until the date of abandonment where they physically hand back the card, and even if you've lost it, that's not considered an abandonment. You physically have to let the immigration department know that you wish to abandon your green card. And at that point, then you can cease your filing obligations with the United States. And green card holders, similarly to citizens, are required to file on a worldwide basis with all foreign reporting obligations. Next is a U.S. tax resident. And this is a term that's defined under the domestic law in the United States. And there's two different tests that exist for the substantial presence test. The first one is 183 days. So if you're in the United States 183 days or more in the year, you are deemed to be a U.S. resident under the U.S. domestic law. And if you're a U.S. resident under U.S. domestic law, you're required to file on a worldwide basis with all of the foreign reporting obligations. Now, the tax treaty between Canada and the U.S. will protect someone from that filing obligation and for only income tax reporting purposes, because it's an income tax treaty. It's not a foreign reporting obligation treaty. It's just for income and taxes. And so even though you may protect yourself from filing what we call a treaty-based return in the United States, you're actually still required and obligated to file most foreign reporting forms that Emily is going to go through after I'm done discussing the obligations here. And so that one actually catches a lot of snowbirds if they stay in the United States 183 days or more. Sometimes we have people come to us who filed their treaty-based return, protecting themselves from income tax reporting, but didn't realize they still had to file all of the other reporting forms that exist in the United States. The second one is the substantial presence test under a 3-year rolling test. And so this one is where you take 100% of the prior year, 1/3 of the second prior year, and 1/6 of the third prior year, and add those together. And if that totals 183 days, then you're again deemed to be a resident of the United States under domestic law. Now, this one, actually, there is a domestic obligation where if you file a closer connection form, so if you're living in Canada and you can prove that you have a closer connection to Canada than you do to the United States, then you actually just need to file that form and you're out of all reporting obligations. So that one, there is something domestically that you can file in order to minimize your reporting obligations, but you do have to file the closer connection statement. And if you don't, you're going to be deemed to be a resident of the United States and subjected to worldwide reporting and foreign reporting obligation. And finally, there's the U.S. tax obligation for non-residents. And this is if you have certain types of U.S. income in which they're subjected to United States taxation, then you're obligated to file a non-resident tax return in the United States. Some examples of that is if you have rental property down in the U.S. And you elect to treat it as effectively connected income and you don't have withholdings on the gross rents, you're required to file a return. Others, maybe a sale of property that is subjected to United States taxation. You're required to file a tax return, whether or not there's a gain or loss. Maybe you have a business in the United States that has a permanent establishment. Again, you would file a United States non-resident tax return. So those are some of the obligations of when you might get caught into the U.S. tax system. I'll pass it over to Emily, who's going to talk a little bit about some of the foreign reporting forms that I've been alluding to throughout my discussion here to help you figure out what might need to be filed on those forms, returns.
Thanks, Krista. So we know U.S. persons are subject to U.S. federal income tax and reporting requirement, regardless where they live in the world. And as Krista mentioned, that often they're protected from U.S. tax liability. Partially, sometimes it's because if you can treaty tie break to Canada, you would not subject to U.S. tax on a worldwide basis. And also for people living in treaty countries with higher income tax rate, such as Canada, they likely will have enough foreign tax credit from their resident country to significantly reduce or fully offset their U.S. tax liability. And for those people, if they're delinquent in the U.S., we're often more concerned about their exposure from failure to file penalties rather than their U.S. federal income tax liability. I'll look at some of these are most common international information disclosure forms. There are more out there, but these are the most common ones we see. And today we're also focusing on individuals. However, do note that many of these forms are also applicable to entities, including corporations and partnerships. Now, looking at the table, you'll know that in addition to monetary penalties for violations, if not timely and correctly filed, many of these forms also suspend statute of limitation. Statute of limitation is an open period during which the IRS can review a return and assess tax and penalties at any time. Once the statute of limitation has run, generally the IRS can no longer do so. Now, normally, the statute of limitations is 3 years from the filing due date of the return, or if it's filed late, then it's 3 years after the return is filed. The problem here is that even if a U.S. person timely filed the actual income tax return, if he missed one of these forms, the statute of limitation could be suspended for the entire return for 3 years after the missing form is filed. Now, if and that's true for actually quite a few of these forms. If the taxpayer has reasonable cause, the statute of limitation could be reduced to just the tax items associated with the missed form instead of the entire return. We'll start with FinCEN Form 114, FBAR, it's often called. This is the most common form required to be filed for clients, and it's probably also the well-known, best-known form among them. Now, it reports bank and financial accounts a U.S. person has as a financial interest in or signing authority over. I do want to emphasize that if this person owns 50% or more of a business, the business's bank accounts considered to be owned by the person. So this person would be treated as having financial interest in and not just signing authority over that account. Another one that's often missed by people is if they have non-U.S. Life insurance policies with cash surrender value, that's reportable on FBAR as well.
You know, sometimes people get caught on this one. You mentioned the signing authority where they're maybe an employee somewhere that has signing authority of their employer's bank accounts for whatever reason, or they sit on a board and they have signing authority. This actually catches probably more people than they think, because sometimes people are like, well, my value is less than $10,000, but if you have signing authority of any type of entity that's over that, it's going to put you over that threshold.
Very true. Take a closer look when you file your U.S. tax returns, just to think about your responsibility and not just what you physically own.
That's right. Yeah.
So the filing threshold is $10,000 US, and this would include all the highest account balances in each of reportable account during the calendar year. All the amounts we're mentioning are in US dollars, by the way. Now, the due date of FBAR is April 15th officially, but it's automatically extended to October 15th. You don't need to file extension request for it. Now, penalties. The penalty for non-willful violation is currently at $15,611. It's an odd amount. It's because it's subject to index for inflation. If the person has a reasonable cause, it would not be, the penalty would not be assessed provided the delinquent FBAR is filed and the account is properly reported. Now, there have been some uncertainty in terms of how this penalty is assessed, whether it's based on form or account. I think it's generally concluded right now it's expected to be applied by form, but that may change. Now, we're only identifying for all these forms the standard civil non-willful penalties here. Penalty, a lot more severe, higher penalty could be accessible if the conduct is willful, or if the IRS has issued a failure to file notice and is not complied with within 90 days. Now, statute of limitation for FBAR is 6 years from its filing due date. Next, we'll look at Form 8938. This is statement of specified foreign financial asset. This form is actually fairly similar to FBAR, but there are some differences, and it's also governed by different U.S. statute. It is more detailed than FBAR in general, and the filing threshold is, however, higher. And it depends on if the person lives inside or outside the U.S. If you live outside the U.S., the filing threshold is higher, and then those living in the U.S. And also depends on the filing status as well. This return, this form is filed with the income tax return itself. The penalty is $10,000. Okay, the statute of limitation is 3 years after the filing, but it could be extended to 6 years if there's a significant amount of underreported gross income related to these missed items, reportable items. Okay, the next two forms are all related to non-U.S. trust, Form 3520 and 3520A. 3520 reports a U.S. owner's interest in the non-U.S. trust, or if somebody has reportable transactions, if the person contributed to this trust or had a distribution from this trust. It could also be reported to by somebody who received more than $100,000 of gift or bequest from a non-U.S. individual or estate. This form is filed separately from the U.S. Income tax return, but it has the same due date, including extension. This form has fairly significant penalty exposure. If it's late filed or incomplete, the penalty is greater of $10,000 or 35% value of property the U.S. person transferred to or distributed from the trust, or 5% of gross value of the trust asset treated as owned by the U.S. person. So if somebody contributed their share in a Canadian corporation worth $1 million to this trust, the penalty could be $350,000. So it can be quite significant. Now,
go ahead.
Yes.
Sorry.
Go ahead,
I was just going to talk about the RESP because I know that this one changed a couple years back for the RESP, which under U.S. law used to be treated as a trust, and then they came out with a revenue procedure, which you're probably talking about now.
That's right. Well, that RESP used to have to be reported on 3520 for the beneficiary and owner, as well as a 3520A. 3520A reports a U.S. owner's interest in this a foreign trust. This one has a different due date. It's March 15th, and you have to file a separate extension request to extend the filing due date to September 15th. Now, this form is usually filed by the responsibility of the trust to file. If the return is failed to be filed by the trust, the U.S. owner could file a substitute 3520A form with the U.S. return, or at the same time as the U.S. return. That would be considered timely filed. The penalty for this form is greater of $10,000 or 5% the gross value of the trust asset treated as owned by the U.S. person. And as Krista mentioned, RESP is generally now not required to be reported on these two forms.
Yeah, and it's not required to be reported. However, under that revenue procedure, if you are delinquent in filing and you did, before they changed it, had an obligation and never did it, you actually still have to file it, which is an interesting thing about this revenue procedure. So if you were not up to date on your filing obligation, then you actually have to file it.
Mm-hmm. Can we have the next slide, please?
Sure.
Now, Form 5471, we could talk for hours about this particular form, but very, very briefly, this form is required by U.S. shareholder, and that's a defined form, to report his interest in non-U.S. corporations. And also, if a U.S. person who is a director or officer of a foreign corporation, they may actually also have reporting obligations if there are certain transactions, or if a U.S. person acquired or disposed of shares in this corporation. So don't take it granted that you may not, if you have certain responsibilities in non-U.S. corporation, you may have to look into it. There are 5 categories of filers, and how they need to report depends on what category they're in. Now, the due date is the same as a U.S. federal income tax return. Failure to file penalty is $10,000 per form. Form 8865 is it's a partnership equivalent of 5471. There are 4 categories of filers. We don't see this form as often as 5471. I think it's also because most, at least Canadians, tend to incorporate rather than conduct a business through a partnership. If you did not file this form, the penalty exposure is $10,000, and as the rest of the forms on this slide, it impacts statute of limitation as well for the entire return. Form 8858, this form becoming more well-known. It reports a U.S. person's interest in a foreign disregarded entity or foreign branch. In terms of foreign disregarded entity, this is something reporting an entity that's recognized as a taxable in a foreign jurisdiction, but disregarded in the U.S. So a good example is Canadian Unlimited Liability Company, which is treated as a corporation in Canada, but it's not treated as a separate entity from its owners for U.S. federal income tax purposes. Foreign branch, from our client in living in Canada, most often they file this form to report their Canadian rental income, or if they have self-employment income in Canada. Those things are treated as their foreign branch.
Yes, and that one changed in 2018, I believe it was.
That's right.
Those types of incomes became reportable as branches under some legislation changes that happened.
That's right. The filing scope expanded. It's expanded at that time. That's right. Filing due date is the same as a return. Now, if you have these business activities you own directly as an individual, the penalty, the monetary penalty is 0. But if you're reporting as a part of foreign controlled corporation or partnership, the penalty is $10,000. Now, Form 8621, I believe we have discussed this form in a lot more detail in a prior webinar. It's related to passive foreign investment company. Most often people file this form to report their interest in non-US mutual funds held outside of Canadian RRSP. There's no monetary penalty for failure to file this form, but it does impact statute of limitation. I think it's time for our polling question number 1.
I'm just going to add one more point here that the statute of limitations and penalties, this isn't just for non-filing. If a form is substantially incomplete or done substantially wrong, that actually can leave the return open to these penalties and statute of limitations being waived. And 5471 is a good example where we see an example I saw was the individual, the preparer, had prepared 5471, but they just checked off category 2 for every year. And it was much more than a category 2. It actually met 3 of the categories. And so they had substantially undisclosed most of the information, which left the return open to scrutiny and statute of limitations for reporting purposes. So it's not just that maybe you missed the form, but if the form is substantially wrong or incomplete, that actually creates a lot of issues as well for U.S. persons.
That's right. So due to all this exposure, these forms is not to be taken lightly.
No, not at all. and they're getting a lot more aggressive with it's similar to Canada with the reporting purposes that are starting to happen in Canada where they're checking stuff. The IRS is now starting to do the same thing. So now our first polling question here. And so the first polling question we have goes back to where I was in that who is subjected to U.S. federal income tax on a worldwide basis under U.S. domestic law? I'll give you a few seconds here to answer the question. There we go.
There we go.
All of the above. That is correct. So under U.S. domestic law, U.S. person, all of these individuals are subjected to reporting on a worldwide basis. Now, if you use the treaty, then you likely can only, it would just be A and B that are subjected to U.S. federal income tax on a worldwide basis. So a little bit of a trick question because under domestic law, it's actually everybody has the reporting obligation. So moving on to our very first option, which is probably one of the most common options that we see for reporting purposes under the disclosures is what's called a streamlined filing compliance procedure. And so this one is available both for amended returns, if something was missed or done substantially wrong, and you need to amend the return to do those disclosures, as well as for delinquent reporting. So if someone just didn't file or didn't report a certain form, you can use this procedure to disclose. There's 2 different kinds. There's the domestic offshore and the foreign offshore. And so the difference between those 2 is just how much time you're spending in the United States. Basically, if you're living in the United States or don't meet the foreign category, then you're going to file under the domestic. And the difference between those 2 is one, there's a penalty associated, and one, there's a penalty abatement option. And so as Emily alluded to on her screen with the penalties, a lot of these are based on non-willful. So you have to be able to prove that you were not negligent in your filing obligation, and in that you really didn't know you were supposed to file it and had no idea, and you're doing the best to be your due diligence as a taxpayer. So, and you can't have been under a civil or criminal investigation by the IRS, and the IRS cannot have asked you for that information. So if the IRS finds the mistake first or the omission first, then we can't use this procedure in order to file your tax returns for some penalty waiving. If someone, and this happens unfortunately more than we like to admit, has already used the streamlined filing procedures, it is possible to use it again. But what happens if you use it again the second time is you basically null and void the first time that you used it, and you have to pay all of the penalties from the prior using. And so again, and this one is, you have to be really careful, because if it's the full tax return, and then you stop filing for 10 years, and then you want to again 10 years later file 3 years worth of returns, they're going to say, are you really non-willful or were you negligent? So you're kind of, your ability to qualify again goes down, because you've already asked for forgiveness once. Now maybe it's that you missed a form and you want to file because you had a new reporting obligation that you weren't aware of, but then you have to go back and pay the penalties from the last time that you used the procedure. So as I said, there's 2 different things for domestic and foreign. In order to qualify for the foreign offshore, you have to be outside of the United States for 330 days in one of the reporting years that you're reporting. And so it doesn't have to be every year under that reporting obligation for the amount of years you're filing, but as long as it's for one of the years you're reporting, then you can use the foreign offshore reporting, which is a much better option, as I stated, because you can get out of the penalties. Whereas with the domestic, you're going to have penalties. So how do you use the streamlined filing procedures? Well, there's a couple different ways. And so one of them is, and the most common one that people will do, is you have to file 3 years of the IRS tax forms and 6 years of the FBAR reporting. And you can go back to what the different forms are, what Emily talked about. And so the 3 years of IRS tax forms is every type of form that is filed with the IRS. So that would be your 3520, 3528, your 5471s, the 8621s, all of those forms that get filed with the IRS, you are only required to remit 3 years. If you have the foreign bank account, the 6 years. I know that's very difficult for some people to find that information, especially if they've closed bank accounts or they've used to be a signing authority here, but they're no longer there. So how do we find the information? You have to do your best ability to find the information, which is the bank account name, number, address, etc., in order to put it on the obligation. And you have to really try and do your best due diligence to get that information. We find it takes people a fairly substantial amount of time when they're doing prior year disclosures, time to collect all of the information that's actually required to do the reportings. The 3520 and 3520A, which is that trust reporting, gets filed separately. It still goes to the IRS, but it's filed with a different department within the IRS. And similarly with the FBAR, it actually gets filed with the Department of Treasury, not with the IRS. So it's filed separately as well. And actually has to be filed in advance, because part of your streamlined package is you have to have proof that you submitted the 6 years, prior 6 years of FBAR, and that gets included with your package to the IRS to show that you qualify for Streamlined. One nuance that happened here is in 2017 with the Tax Cuts and Jobs Act, there was a change in law with respect to individuals who controlled non-US corporations. So if you're a person who had not been filing your US tax returns and are now trying to catch up, if you control a foreign corporation, or sorry, non-US corporation, so a Canadian corporation, and that's a profitable corporation, you actually have to start filing at 2017. So this 3 years of IRS tax form is actually not applicable, because you have to go all the way back to the point in time when it was called mandatory repatriation, where the IRS brought into law that any non-corporation, you have to deem including all of that income in your US tax return. It's no longer protected income in a corporation and allowed to be deferred. And then on an annual basis, there's something called a GILTI, global intangible low taxed income inclusion. And so the 3 years no longer exists for individuals who own non-US corporations. That's a controlled. So you don't have to control it, but if US persons control it, then it's a controlled foreign corporation and you have to go all the way back to 2017 and file forward. So this can, some people, I think, thought, oh, I just won't file and I'll wait to file so that the mandatory repatriation won't kick in. Surprise, it still exists. You actually have to go back. You can't only file 3 years of tax returns. And so as I stated, the foreign offshore, you receive a penalty protection. So this generally, as long as you're non-willful, will be an automatic penalty and they will not assess penalties. In all the years that I've practiced for a couple decades here, I've never seen the penalties assessed in non-willful, but as I mentioned, they are starting to get a lot more aggressive in this. And I would be surprised if they don't start challenging whether someone was willful or non-willful, because they've even talked about shutting this program down in recent years. So we'll see what happens with that. The domestic offshore filer, so that's the person who doesn't meet that 330-day test, you have to pay 5% of all of your foreign financial assets. So the assets reported on your FBAR, and that's a penalty that needs to be paid with the tax return. There is no possibility to ask for reasonable cause. That is a final penalty. You must pay it and move forward. So if we can not file under domestic Streamlined, that's generally our preference if we can find another program that exists for individuals to file under. But if it is the only one exists and it makes sense monetary wise with respect to your assets and how much they are for this 5% penalty, then sometimes we will do it. So you'll hear us talk throughout this webinar on all these different options that are available. It really depends on which one creates the best financial results for you, as well as protecting you from statute of limitations and going forward. If you're accepted under the Streamlined filing procedures, the statute of limitations kicks in. So they generally will not go back to future years as long as they deem that you're non-willful.
Mm-hmm.
Yeah.
Krista, we both mentioned non-willful, but maybe you can elaborate on what that means. And also, when you said if somebody decide to wait for a few years before becoming compliant, is that indicative of
exactly
willful?
That at that point, I would say you're willful. You've made the choice not to file because you wanted to avoid taxation or reporting. And so if there's a point when you have knowledge of your reporting obligation, you've made a choice to continue not to file, you've willfully made that decision to non-file. It's a very subjective option. They would need to prove it, but it's obviously, as a taxpayer, we have the burden of proof. So if they say, no, we think you're willful, you have to prove to them that no, I didn't know. We'll talk about it a little bit when we're talking under reasonable cause, but quite often we hear people say, well, my tax preparer didn't tell me I had to do that. Unfortunately, it's a taxpayer's obligation to know what they need to file and not file. And so merely just saying I trusted my accountant isn't going to be something that will always protect you under willful or non-willful, because we as taxpayers are to try and find out what we're supposed to file. Now, I will say, we do use it quite often because unfortunately there is a lot of preparers out there who file these returns and miss a lot of the foreign reporting obligations, because it's what you don't know, you don't know. And we require all of our clients to fill out a checklist, and that's to protect them. I know some people have the knowledge, oh, my accountant makes me fill out a 20-page questionnaire. Well, that's because there's 20 pages worth of things that we need to know to make sure to protect you and to protect us. And so merely not filling out the checklist is actually a willful act. You're choosing not to disclose the information. So that's another thing to think about. So I think we got one more question here. Is I can file more than 3 years of tax returns under the Streamlined filing procedures? So the answer is yes. people can file more than 3 years. So it's minimum of 3 years needs to be filed with the streamlined reporting. We actually have instances where sometimes people choose to file 5 years. And the reason for that is because they want to renounce their US citizenship or they want to abandon a green card. They come to us, realize they didn't have to file, maybe didn't realize they were a US citizen, because if you remember at the beginning, I talked about US citizen. Maybe you were born to US citizen and didn't realize you had an obligation because you'd never personally lived in the United States. Those people sometimes want to give up their US citizenship. And in order to do that and not be a covered expatriate, you have to actually file 5 years of tax returns and be compliant for 5 years. So sometimes under our streamlined procedures, we choose to file 5 years of returns instead of 3 years so that people can then renounce their citizenship. Also, if you're subjected to the mandatory repatriation, you actually have to file more than 3 years under the rules of a streamlined reporting procedure. So the answer is yes, you can file more than 3 years under the streamlined procedures. Yeah. Awesome. So we'll move on here. Maybe if you want to talk about one of the other ones here, Emily.
I do. So Krista mentioned the streamlined procedures, which is actually a very attractive program. And we used this program to help many of our clients become compliant. Now, if you're not eligible for it, then that's a potential option is a delinquent international information return submission. This could be a good program if this person, first of all, has reasonable cause for the failure, and they have previously filed their income tax returns, but missed 1 or 2 disclosure forms. And also this has to be voluntary, so the IRS could not have contact them about the missed forms. The procedure here is they would file the applicable returns and with the applicable disclosures that had been missed. And if they are required to file 3520 and 3520A, but didn't, they would still need to file that separately. For each of the forms that you're filing under this program, attach a reasonable cost statement, okay? And hopefully IRS would pay attention to that statement and not apply penalties. However, this program does not provide automatic penalty protection. So even if you attach this program, IRS could still go ahead and assess penalties, and you could go back and refile these reasonable cost statement, and IRS would not assess penalty if it's accepted. If not, you could be potentially exposed. So one thing about this program is a degree of a lack of certainty in terms of penalty exposure.
Yeah, and I think, what's interesting, we've seen, so there are a few forms that the IRS has deemed to have automatic penalties, meaning it gets filed, put it in the system. If it's late, their system kicks it out as a penalty. One is 5472, which is a business reporting form. The other one is 3520A. So a while back, they deemed these forms to be automatic penalties. So unfortunately, sometimes what happens is we file with this reasonable cause statement, and then you get the penalty, and then you have to go back and fight it under reasonable cause because their systems just automatically kick out penalties for certain forms.
That's right.
Yeah. Especially when we paper file stuff, because it takes a long time to get through their system.
Especially now, and that's actually true in Canada as well.
Yes, that's true in Canada as well. Exactly. So then, sorry, did you have something else, Emily?
Oh, I want to alert us. A couple of participants specifically asked about FBARs in advance of this webinar, and what Krista is going to talk about. This may be the answer for you.
That's right. Yeah. So there is actually a separate program just for FBARs. That exists, because it is actually quite commonly missed by individuals because it doesn't go with their tax return. I think we typically find this where people get their returns prepared down in the United States or with a smaller firm. They may not know all the foreign reporting options. They just know to file the tax return, put your income on it, claim foreign tax credit, and you're good. So this is one of the ones that gets missed, unfortunately, even though it's very well known, I think, out there now with the reporting obligations, and especially with Canadian banks asking people of their US status. I think a lot more people are compliant, but if they're not, or if it was done wrong, you can file under a separate FBAR submission. And so similar to all other programs, IRS can't be under IRS investigation. You can't be contacted with the IRS, which is, it's funny to me that this is part of the rules because this isn't even an IRS form. This is filed with the Department of Treasury, but it's part of their ability to be eligible. You can't have IRS coming after you for it, which I don't know why they would, but that's part of the rules.
Has to be voluntary.
Filed it. Sorry?
Has to be voluntary.
That's right. It has to be voluntary. You don't actually, so a lot of the other ones that are reported, so all those other forms aside from FBAR, if you're filing them, even 3520, even though, and 3528, even though it's going to a different department, if you're only filing FBAR, you're not actually required to include an amended tax return. So all of the other forms, even though maybe nothing changes in the income tax reporting, you have to file an amended return to include them. And so this one, you merely can just file the returns with the Department of Treasury without doing an amended income tax return. You have to tell them why they were missed, why you forgot them, or maybe it was you forgot to include accounts that had signature authorities, whatever them might be. You have to provide a statement as to why it's late filed to show that, you know, there's a reasonable reason. And you hear this constant, us talk about this term reasonable, why you missed your filing. It will be an automatic penalty protection, but only if any income associated with the missed accounts had been reported on your tax return. So if you actually miss the account and miss the income, then this one wouldn't exist for you, and probably be looking at the other ones that we talked about within Streamlined or those types of reportings to protect you instead. So maybe we'll talk about the new one that just came out, Emily, which is for former citizens, those who have renounced. And this is really new in the world of reporting.
That's right. So I think this was introduced in 2019, as you said. The purpose is to help delinquent former U.S. citizens who have already expatriated or planning to do so to become compliant and to avoid what's called the covered expatriate status. On expatriation, I'm sure we had previous webinars about the covered expatriate, and I would invite you to go back and review that if you missed it. Now, who's eligible for this? Again, the failure has to be non-willful. The date of expatriation needs to be after March 18th, 2020. They could not have previously filed as a U.S. citizen or U.S. resident. They could have filed as a non-resident of the U.S. That's fine. Their average net U.S. income tax liability for the 5 years preceding the year of expatriation has to be less than $190,000. And this is if they expatriated in 2023. This amount is indexed for inflation. So if you expatriated in an earlier year, this threshold would be lower. And also, this person has to have less than $2 million US net worth at the time of expatriation and also at the time of the filing under this procedure. Lastly, the total income tax liability in the US for the years of expatriation and the 5 preceding years has to be $25,000 or less. Now, if the person is eligible, they're required to file 6 years of tax returns and required information disclosure forms. Mm-hmm. Now, this part is interesting. If the person has not previously applied for U.S. Social Security number or individual tax identification number, and one of these is usually always required to file U.S. income tax return. But if they don't have this, they don't need to apply for one to participate in this program. And no failure to file penalty will be assessed. And the best part, and this part also I find it really interesting, if you have a tax liability and that's under $25,000, when you file under this procedure, you don't have to pay for it. I'd like to think it's a parting gift.
You know, it's interesting because this one came about at the U.S. has seen record-breaking numbers of renunciations of citizenships as of recently years. I'm not sure if that's why they brought this procedure out or not, but again, this is when I talked about the mandatory repatriation, if people choose to do things a certain way in order to avoid tax, you need to be careful. So this one, you may not have to pay your tax liability, but if you know you have to file and then you choose to renounce in order to fall under these procedures, are you really non-willful? So this is just things you need to be careful of, right? You can't you can't do tax avoidance planning in order to fit in one of these procedures. It really has to be on accident, I guess, if you will.
That's right. Well, this program, I think, is fairly narrow in scope, so not too many people would qualify, but if you are eligible, this is a great one to use. That's
right, exactly. So then time for our final polling question. So for relief procedures for certain former citizens, what is part of the eligibility requirements? So this is what Emily just talked about. Which one is actually is part of the eligibility requirements? All right, so Emily, you want to let people know what it is?
Oh, okay. The correct answer is A. The net worth has to be less than $2 million. The person at B is incorrect because you could not have filed as a U.S. citizen or resident. And also for C, you have to agree to file 6 years of return. Or as such, D is not right either.
Awesome. Thanks, Emily.
Quite a few people got it right. Well done.
That's right. And so just to kind of wrap up here with it, there are other procedures. We're not talking about them as detailed as the other ones, merely because they're less frequently used, I would say. So the quiet disclosure is you basically just file 6 years of returns quietly and hope nothing happens. We generally don't recommend this one because it doesn't protect you from the IRS going back further. And it doesn't protect you as much from penalties because you're going to have to either rely on reasonable cause or first-time abatement. And so generally under a quiet disclosure, it isn't always the best option. Now, there is times when it makes sense to do that depending on a person's, what they're filing, but it's not always the right one. Reasonable cause, as we talked about already, this one is hard to get. You can't say my accountant didn't tell me, saying I didn't know. You really have to prove that you did your due diligence to make sure you did things accurately and tried your best effort to file. Again, like I said, if your accountant has a questionnaire and you didn't fill it out, that's not the reasonable reason for not filing. First-time abatement is a penalty relief program that's a use it and then lose it type of situation. You get to abate penalties, and it's for a first-time offender, basically. So if you kind of don't fall into anything else, you would use this program and say, please forgive me under my first-time abatement. And it's a request that you make to the IRS to forgive you for penalties on filing. Again, this doesn't protect you from the IRS going back like the other procedure as well. This can leave other years open to scrutiny, and the IRS may be saying they want to go back further if you only file a certain amount of time versus all of your reporting obligations. And then the last one is criminal investigation. So this is kind of the last resort if you're willful. It's an actual procedure, which is a very daunting title, if you will, criminal investigation. But this one is a procedure where you have to actually apply to be a part of this program, if you will, and be accepted into the program for disclosure of non-filing. And so this generally will be used if it is a willful neglect of filing your tax returns and you're subjected to a bunch of penalties, and you will be subjected to the penalties. This one, you don't really get much protection, but it just helps minimize the amount of reporting that you have to do to the IRS. And so with that, we've come to the conclusion of our webinar. We will stay online here for a bit to take a few questions. Just a reminder, you will receive a link to our survey. If we could please take the time to fill that out, respond, give us some feedback on how we did and other topics you like covered. And I really appreciate you taking the time to join us for this webinar. And thank you, Emily, for participating with me. Janice, who's been behind the scenes monitoring some of the questions with Kenneth. Is there any questions that you would like to put forth for us to answer?
Yes, Krista, we received many questions from the audience today, but due to the limitation of time, we will try to answer some questions here, and we will collect the rest and answer during our upcoming webinar. So the first question is, do you need to file 3520, 3528 for the Canadian tax favor foreign trust? Like RESP or DSP for prior year under the procedure that you just discussed, even though the IRS granted the reporting relief in 2020.
Yeah, as we mentioned, if you have an RESP, but you did not disclose it and you're filing under streamlined procedure, you do need to file 3520, 3528, because the revenue procedure is only applicable if you are up to date on your filing. So meaning you had filed the 3520 and 3528 up to 2018, then you can qualify for non-reporting.
It's an ongoing forward basis.
Yes, right.
That relief.
Yeah, and then ongoing forward, you would have relief. That's right. But you have to be up to date.
Thank you. So the second question is, if a client owes 20% share of a foreign company and he does not have the signature authority over foreign bank account, does he need to report this account on his FBAR under ownership of signature authority rule?
You want to take that one, Emily, on FBAR? So if it's 20% owner and no signature authority?
On the service, I think the answer is no. But it would always be a good idea to have some more fact and have a closer look.
Yeah, and see if it's a controlled foreign corporation.
Yeah.
It depends. It might need to be reported, might not. Maybe two more here.
Okay, so the next one, I think you discussed a bit during your webinar, but can you provide more detail about what is IRS standard for the willfulness and whether a person with learning disability count as a willfulness?
Well, I think it would depend on what they've done for due diligence to determine their obligation. As I said, it's getting harder to prove non-willful, although we're still doing it and they're still accepting it because there's been a lot of information out there lately on requirements to file. Where we see the non-willful is maybe missing a lot of those forms Emily talked about, but there's no bright line test. It's a very subjective test on what's willful and what's non-willful. It's not defined. And so someone with a learning disability, I don't know. They may accept that. It's truly up to them to decide if they want to choose it as willful or non-willful. Maybe anything else to add to that, Emily? Or
I totally agree. I think a lot of times it's case by case basis, very much fact specific. And if you can show more mitigating actions that you have taken, that would be helpful as well.
Yeah, awesome. Is there one more maybe quick question here before we wrap up?
Yes, the question is, what fact do you need to include in completing the narrative statement of the fact portion on the form 14653 or 14654? It's the form with the Streamlined offshore.
Sorry, I didn't understand the question. What do we need to include? What? Sorry.
What do you need to include at the facts in the form?
The facts.
Yeah.
Well, you need to include the reason why you didn't file and what you're disclosing.
I want to add that if you're considering participating in Streamlined filing, I highly recommend working with tax professionals just to make sure that you are fully compliant. You don't want to participate and not and still file something incomplete or incorrect.
Exactly. Awesome. Well, thanks everybody. And as Janice said, if we didn't get to your question, because there was a number of questions, we'll make sure to reach out and get back to you just with a quick answer for you for things that need to be responded to. Our next webinar is coming up on August 29th, and that will be tax on digital services from Canada and the United States. It'll be myself, I'm doing again, with Senior Manager Les Zhao and a colleague of ours, Nicholas, who is going to be joining us to also talk about the indirect tax portion and not just income tax portion. So thanks again. I appreciate your participation, and thanks, Emily, for co-hosting with me.
And thank you, Janice and Kenneth, for helping.
Yes, and right, Janice and Kenneth, sorry.
And there's a whole team behind this, actually.
That's right, exactly. Amazing. Thank you.
Thank you. Bye-bye now.
Bye.